FOMC's strategy for achieving its goals, our policy framework, must adapt to meet the new challenges that arise.
Federal Reserve Chairman Jerome Powell laid out an aggressive new strategy Thursday aimed at getting millions of Americans back to work by agreeing to sometimes let the economy run hotter than the Fed's 2% inflation target before tapping on the brakes with rate hikes. In effect, the Fed is shifting from a hard inflation target to a soft one, in another unprecedented step to prove the age of easy money is here to stay for as long as necessary.
We're not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021.
All right. Today is Tuesday, the 26th of August. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. It seems that the market took one conclusion out of the Jackson Hole speech, which is, now we got Jay Powell open to cutting interest rates. And that's it. The market tuned out and muted everything that came after. The market now assumes that we have the September rate cuts in the bag. And not only that, perhaps we have two more in October and December. And this is, of course, the fault of Jay Powell. He's a shitty communicator. The impression that we got from the speech is, of course, Powell chickened out, and hence we call him Paco. But I think that the market is making the wrong assumption right now, and it's in for a massive surprise. I'll show you why in a minute, but for me, the most important take from the Jackson Hole speech was, if you go back to 2020, of course, as you've seen in the intro of the video, Jay Powell, in his most disastrous speech ever, he said we're going to do average inflation targeting, meaning if we go above 2% for a little bit, that's okay. But of course, it backfired right in his face. If you look at this screenshot right here, Jay Powell back in 2020 said that low inflation can pose a serious risk to the economy. And this is why Jay Powell is the dumbest Fed chairman that we've ever seen. Now you fast forward to 25. In his Jackson Hole speech, Jay Powell officially ended the average inflation targeting bullshit. And now he has a new framework. And the framework says that we're going to have a target of 2%, and we're going to follow that target. Now, if you're going to target 2%, you're above 2% right now. You're closer to 3%, not 2%. So how does that make any sense with the market assumption that we're going to have rate cuts? Big contradiction. And this is why I say that the market probably jumped the gun. So let's dive right into it here, folks, and talk about it, because we have an important series of events that could change the entirety of the outcome of what the market is assuming right now. Of course, the statement that the market wanted to hear, and they got it, and then tuned out the algorithms on Friday, pumped the stock market higher, and just tuned out the rest of the speech, is when Powell said that conditions may warrant interest rate cuts. Now again, you're above the Fed target, so cutting rates right now, if you say that you're gonna aim for the 2%, not average 2%, cutting rates doesn't make sense. It would make sense if you're below 2%. But in his speech, of course, Jay Powell talked about the dual mandate, or what I call the duality of the risk. You have inflation, you have recession, and if both of them are going higher, then you got a stagflation phenomenon in the economy. Now it comes down to which risk poses the most immediate threat. That has to be mitigated first. And if it is the inflation risk, then you cannot cut rates. If anything, you should hike rates or pause, continue to pause. If the answer is the recession risk carries an immediate problem than the inflation risk, then it merits cutting interest rates, but the expense of that could be inflation heading higher. Now, in my assessment, if we go back to the conversation from last week, in my assessment, and I showed you the evidence, the inflation risk is higher than the recession risk. But it seems, based on Powell's speech last Friday, he thinks that the recession risk is higher than the inflation risk, even though he acknowledges that we have the duality of the risk. Take a look.
So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. When our goals are intention like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
In other words, what Powell is trying to say, and he's too weak, of course, to say that specific word. It's called stagflation. Even though we all know right now, it's evident to everybody. We've been talking about stagflation, by the way, in this channel since 22. That's going to be the inevitable outcome. Now everybody begins to notice it, even though it is still a mild form of stagflation. But this is where we are right now. And any Fed mistake right now in the policy could exacerbate the stagflation problem. Now, why would Jay Powell avoid saying stagflation? Because if he admits that, he pretty much says that I admit that I'm handicapped and there is nothing I can do to rescue the economy from the stagflation phenomenon. And if he says stagflation, the algos would take it as a negative and dump the stock market. So keep that in mind. But let's go back to the risk board and do the assessment, because Powell once again thinks that the recession risk is higher than the inflation risk. I disagree. I think it's the opposite. But let's examine why. The case for the recession risk posing an immediate threat to the economy stems from 2 points: the job market weakness and consumer weakness. Let's talk about them one by one. I tweeted this the other day and I said the weakness in the job market is a result of 1. Revisions of government jobs. 2. AI-related layoffs, what they call efficiency. Right? When you lose your job, they say, oh, we're just aiming for efficiency. Add insult to injury. But anyways, number 3 is the immigration policy. And if you're not convinced that this is the case, go back to, again, the series of videos that we made when I covered the latest jobs report and I explained to you why we see weakness in the job numbers. It's because of these 3 elements. It's not because we have widespread layoffs all over the economy, because everything is falling apart. And I say that none of these can be fixed by rate cuts. Powell made a mistake today by giving too much hope. He will be corrected by the data in September before the FOMC. So again, if the case for Powell to cut rates is job market weakness, it's a big mistake, because rate cuts cannot and will not mitigate the reasons why we see higher unemployment in the economy right now. What about the second point, that we have consumer weakness, and that merits interest rate cuts to help consumption in the economy? Now, we know that consumer weakness is coming from mid-income, low-income consumers. Those are the ones suffering, and they've been suffering for a long time now. The assumption by Powell that if he cuts rates right now, that's going to reduce the interest rate in the economy that the consumer uses for credit cards and mortgages and alleviate some of that consumer weakness a little bit. Here's the problem, though. We have solid evidence from the jumbo rate cuts that Powell did last year in September. Even after these rate cuts, interest rates in the long end of the yield curve, the 10 to the 30 bond yield, actually went higher, not lower. And thus we've seen mortgage rates go higher, we've seen credit card rates going higher, we've seen auto loan rates going higher, and the consumer kept getting squeezed. Look at what's going on in Europe right now. The Bank of England been cutting rates, the EU been cutting rates, yet we continue to see that bond yields in the long end of the yield curve, which what influences the borrowing rate for the consumer in the economy, been actually heading higher. It's been getting out of control. So the message to Powell here, if you think that cutting rates somehow will alleviate consumer weakness, maybe you got it wrong. And when you cut rates, you're only going to influence the short end of the yield curve, meaning all the way to the 2-year note yield, not the long end where we see mortgage rates, auto loans, credit card interest rates. When you have the short end of the yield curve going down because of interest rate cuts, that causes inflation in the prices of assets. And this is why on Friday, when we've seen rates going down in the short end of the yield curve, all risk assets went significantly higher. Bitcoin, shitcoin, the stock market, the riskiest assets went higher. And we know that when the stock market goes higher, it influences more consumption by the affluent consumer. And so long as the affluent consumer continues to spend, they keep inflation and prices continue to go higher. So if you cut rates right now with the excuse that, I'm going to help the middle income, the lower income consumer, you're actually going to hurt them, because the rates in the long end of the yield curve will go higher. And on top of that, the affluent consumer will begin to spend more, causing more and more inflation risk. So we go back to the board. There is no reason No valid reason right now for rate cuts. If you say job market weakness, I just explained to you that rate cuts would not mitigate that. If you say consumer weakness, I just told you and explained to you that if you cut rates right now, it would actually backfire. It will cause more weakness in spending by consumers other than the affluent consumer. What is the case to say that inflation actually carries the most immediate risk than recession? Number one, the tariffs. Number two, the affluent consumer. Number three, AI spending. Let's talk about them one by one. If we talk about tariff, of course, the argument right now is, Trump made all of these tariffs and we haven't seen a lot of inflation. Why? Because companies been eating it. If you look at June 2025, the tariff cost, U.S. businesses ate the most of it. But if we look at October 2025, based on what these corporations are saying, the burden is going to be shifted down to the U.S. consumer. So the increase in pricing because of tariffs is coming. And on top of that, we had the suspension of the de minimis rule, which exempted packages coming from overseas with a value less than $800 from the tariff. Now, got to pay the tariff, which again, what is that going to do? More inflation in the economy. We have to pay more for the goods because of these tariffs. The exemption known as the de minimis exemption allows packages worth less than $800 to come to the U.S. duty-free. A total of 1.36 billion packages were sent in the year 2024 under this exemption for goods worth $64.6 billion. So think about the tariff rate on $64.6 billion. Yeah, it might cause some consumers not to spend and buy packages anymore, but at the end of the day, it increases the price for the consumer. So the inflationary effect from these tariffs is higher than the recessionary effect. It is set to expire Friday. On Saturday, postal services around Europe announced that they are suspending the shipment of many packages to the United States amid confusion over new import duties. On top of that, the White House now says that we have furniture tariffs coming later this year. And if that was not enough, we also have the pharmaceutical tariffs coming soon. Where do we get the active ingredients from to make all of these drugs? If you look at brand drugs, they come from the EU, 43%. If you look at generic drugs, 35% of these ingredients come from India. In the EU, we have 15% tariffs right now. On India, we have 50% tariff. When you look at the origins of the U.S. prescription drugs, injectable drugs come from the U.S. for the most part, 45%, but pills, 60% come from India. Again, we got 50% tariffs in India, and it doesn't seem that that relationship is being fixed right now. Matter of fact, we got the headline today that Indian Prime Minister Modi refused Trump's call 4 times in recent weeks. And if anything, India right now is making meetings with China, with Russia, as in to say, you know what, we're going to move away from the United States. And Trump threatened that if we don't have a deal or a negotiation, he can up the tariff on India from 50% to 60% to 70%, whatever number he chooses. That's going to increase the cost of drugs in the U.S. Despite, of course, what Trump says, he said that he's going to reduce drug prices by 1,400 to 1,500%. So apparently the president doesn't know how math works. And in reality, if we have tariffs on India, if there is no exemption, it's going to cost higher prescription prices. So you see that the inflation pressure is coming from all over the place. Furniture, pharmaceutical products, smaller packages, all kind of goods. The tariff cost will now be passed from the business all the way down to the end consumer. We go back to the board. Number 2 in the inflation risk, the affluent consumer. We got the data from BOFA. You can see that if you look at spending growth in July 2025, we've seen a rebound led by the higher income consumer. You see that orange line going higher again, but the lower income consumer in blue continues to be devastated. And again, lower income households have a relatively small shares of consumption in the economy. Over 50% of the consumption in the economy happens by the affluent consumer. And again, lowering rates right now, causing the stock market to go higher and risk assets to go higher, will only encourage the affluent consumer to continue to spend more. So you're not going to fix the problem here, Mr. Powell, if you cut rates with the aim of, we have consumer weakness from the middle class and the lower income class. We're actually going to hurt them more. And the evidence that we have consumption by the affluent consumer tied to the performance of the stock market. Notice what happened here when we got to the market heading down in a sharp correction back during the heat of the trade war. In April, we've seen consumption going down. As the stock market began to recover, we've seen a rebound in spending, specifically led by the affluent consumer. Now, of course, there is some uncertainty that could happen that could damage the appetite of spending by the affluent consumer in the economy, such as the tariff. For example, today we got Lamborghini CEO who said that the tariff are causing even the wealthiest buyers to pause. So if Lambo buyers beginning to feel the heat from the tariffs, that could mitigate the inflation risk a little bit. But again, if you cut rates and you do that prematurely, you cause risk assets to go higher, and at some point, even with the tariff cost, maybe it's going to impact certain goods such as Lambos, but it's not going to prohibit the affluent consumer from booking airline tickets, traveling, spending on restaurants, and that's just going to keep the stagflation phenomenon in the economy going. Because if the affluent consumer is spending at restaurants and hotels and many other businesses in the economy, employment will stay. They're not going to fire the staff at the restaurant or the airline crew, but at the same time, we continue to see higher and higher inflation. And these employees, these workers, sure, they have a job, they're getting a salary, but that wage is not keeping up with inflation. And the longer that continues, sooner than later, a lot of these workers will demand higher wages, and hence the inflation risk is still pretty high. We go to the third point, which is AI spending. You look at the spending by the big cap technology companies, Meta, Google, Microsoft, Amazon, we're talking about almost $100 billion this year. What do you think rate cuts will do to that? Is it going to stop the spending or encourage even more spending by these companies now that the borrowing rate is less than before? And when these companies spend, they're in a war right now. Who's going to build AI faster? Who's going to dominate faster? Who's going to do penetration in the market faster? Which means if you have Microsoft, Google, Meta, Amazon competing on construction equipment, on electricity, on any resources, they're not going to be price sensitive. They'll pay the highest price they can to get these resources right now. And that's causing a lot of inflation. Like I said, if you cut rates, you will exacerbate that source of inflation, not mitigate it. Does Jay Powell understand any of what I just said? Doesn't seem that he does. Does President Trump understands anything of what I just said? Of course not. So this is where we are right now. We have this game of chicken where you got Jay Powell saying, yeah, okay, maybe I'm going to cut rates, but maybe not. Push comes to shove in September, he might not do it. He might be just saying that right now, but once he's confronted with the data, he might not cut rates. We'll talk about that in a minute. I'll show you why. At the same time, the president is playing his own cards by adding more pressure on Powell to capitulate and cut rates regardless of the inflation risk. He now got rid of 2 governors, one voluntarily, one got fired today. And as we suggested before, that this is Trump's strategy to squeeze Powell. Maybe he can't fire Powell. It'd be too controversial. I mean, technically he can, but it's going to be a big problem. So why not fire the governors and replace them with friendly governors? We're going to pressure Powell to cut interest rates. That's the strategy. That's the game of chicken that we see right now. But here's why, folks. When I say that the interest rate cuts are not in the bag and we could be in for a massive surprise, a big trap in the market. Why is that the case? See, before Jackson Hole, I gave you this slide right here. What if Jay Powell is dovish? What if he's hawkish? And it really depends on what the market interpretation is. And as I said, the market looked at one statement and then tuned out. And the market's take was that Jay Powell is dovish. He's capitulating now. And I explained to you that we have 3 main drivers of the market movements right now. You have the short end of the yield curve. Let's say the 2-year. That's what's influenced the most by the Fed decisions. And the assets most influenced by the short end of the yield curve would be small caps, would be regional banks, high beta assets, risk assets, cryptos, memes, etc. Then you have the long end of the yield curve, let's call it the 30-year. That impacts the big indices. It impacts real estate. It impacts dividend stocks. It impacts home builders. And then, of course, you have the dollar. The dollar impacts other currencies, but it also impacts metals and commodities. And you've seen that because of the dovish assumption from the market about the Jackson Hole speech last Friday, all of these assets went higher because the 2-year went down, the 30-year went down, the dollar went down. But Monday, there was a little bit of rethinking by investors and traders that maybe we're jumping the gun here. Why is that the case? Let's look at the timeline that we got. It begins as soon as tomorrow, by the way. Here's you with your nice hair, and you got NVDA coming out tomorrow. Now, why is NVDA a macro event? Because the stock market is. And NVDA is the highest market cap in the market. If it goes up, it leads the market higher. If it goes down, it leads the market down. And that's going to impact, of course, the psychology of the affluent consumer. So keep that in mind. We got 2 scenarios. Either NVIDIA is going to deliver and show more and more growth in the pipeline, or it's going to disappoint. The other thing before we talk about the scenarios, you got to keep in mind that we have a lot of margin right now, meaning that if NVIDIA, for example, goes down because of a massive disappointment, you're going to see sell-off across the market because we have about $1 trillion worth of margin right now. If NVIDIA goes down, we're going to see margin calls across the board, and we're going to see sell-off, a big one. Not to mention, of course, that right now we have the most expensive valuation in history, surpassing the dot-com bubble and the run pre the Great Depression, 1929. So any problem with NVIDIA will have a sizable market impact and hence a sizable macro impact because of the influence on the affluent consumer. So suppose NVIDIA comes out pretty good, hey, growth is still intact, we see more growth to come. Would that really change the Federal Reserve's or Jay Powell's, or let's say, be honest with you, the market's interpretation of what the Fed is going to do in September? Would that change? Of course not. And this is why we're going to say that the 2-year yield is probably not going to move much. Now, the long end of the yield curve, the 30, would probably move higher because stock market moves higher. Affluent consumer spends more, and that keeps inflation higher. And the dollar will probably move higher because maybe the assumption by the market will be, okay, we'll get a September rate cut, but since we have NVIDIA doing okay, the stock market going higher, maybe the Fed doesn't need to cut rates beyond that. Maybe the Fed will do one and just stop, and the dollar rebounds higher. Now, if NVIDIA disappoints, the market reaction would be the long end, the short end, the dollar, all of them will head down, assuming that, okay, now we have a problem in the stock market. The AI bubble is showing weakness, which means that the market could go down and influence spending by the affluent consumer negatively. And that requires more Fed interference via rate cuts. But even after NVIDIA, it's going to get more complicated because we have the next event, which is the PCE report. Now, the PCE is a lagging indicator. We already know what the reading is going to look like, ballpark. But we could have a problem. Here's the headline from Yahoo Finance. It says how July PCE could derail Wall Street's current bullishness. How would that happen? If we see the PCE coming out super hot, if it comes out with clear evidence that we're now going to trade above 3%, we're not going to dip down closer to 2%. If that is the case, and this is why I have the spicy icon, then we're going to see the 2-year, the short end, the 30, the long end of the yield curve, and the dollar heading higher. Why would they head higher? Assumption that the Fed cannot cut rates. And if anything, we might begin to talk about rate hikes. But absent of a super spicy reading from the PCE, we're just going to take whatever we got from NVIDIA's earnings and move on to the next event. And the next event will be the jobs number that comes out next week. Either it's going to be strong or weak. Now, you all got the impression from the last report that we have weakness in the jobs market. And that's the basis for interest rate cuts. At the same time, we have changes in the commissioner. What if the jobs number come out pretty strong? It shows strength in the economy, and that was just a one outlier because of the revisions in the last report. That we will see the 2-year, the 30, the dollar heading higher because, once again, there is no need anymore for interest rate cuts. And that could impact certain assets negatively, such as the small caps, because the small caps thrive under the assumption of rate cuts. Now, if we get a weaker jobs number that comes as a confirmation that the July report was actually accurate and we continue to see a downtrend in employment in the economy, then the market will assume that we're going to have more easing. If we were pricing 2 rate cuts, now we're going to do 3. If we were pricing 3, we're going to do 4. So you're going to see the long end, short end, the dollar all heading down. Now it gets a little bit complicated because the next event that we're going to have is the CPI and PPI for the month of August. Suppose we get a strong jobs number and then we have a hotter CPI and PPI, that we're just going to see yields exploding higher. The short end, the long end, the dollar is going to go higher. And that's, of course, going to crush the rally that we've seen recently in home builders, in the small caps, in some of the metals and commodities, because now you have a strong jobs number and you have a strong inflation report too. What if it is a strong jobs number, but we have cool inflation readings? If that is the case, then the assumption for rate cuts is going to hold, and this is why we see the 2-year heading down, but the assumption that rate cuts will exacerbate inflation as the tariff risk begins to roll in the next few months, that's going to still hold. So we're going to see the long end heading higher, but the dollar heading down, because the dollar is going to be more responsive toward rate cuts, which will be locked. If we have a strong jobs number but weaker inflation report with all of the political pressure that Powell is under, he's going to do it in September, at least. What if we have a weaker jobs number and then we see a weaker inflation report? In that case, it merits cutting rates aggressively because you don't have an inflation problem and you have a weaker jobs number. So we're going to see rates across the yield curve plummeting along with the dollar. And again, that could be good for certain assets such as small caps, home builders, gold, a lot of the metals and commodities. They're sensitive to the dollar. What if we have, this is the worst case scenario, by the way. What if we have a weaker jobs number But then we get a hot inflation report. Jerome Powell made it clear that the recession risk is higher than the inflation risk, in his opinion, of course. So he's going to be responsive more toward the weaker jobs number than the hotter inflation report. And he's going to proceed with the rate cuts. And this is why I think that the 2-year will head down. But since we have a hotter inflation report, the longer end of the yield curve is going to respond to inflation risk. And we're going to see the 30, maybe the 10, all the way to the 30, heading higher. The dollar is going to go down, though, because when you have rate cuts, you're easing the policy, you're increasing the supply of money, and you're devaluing the dollar. But this is the worst case scenario because it's going to affirm stagflation, weakness in the jobs market, but accompanied with hotter inflation. And even after all of these scenarios, folks, we head to the FOMC after that. And a lot of things will be priced in based on these events. Now the question becomes, would Jay Powell be dovish or hawkish? Would it be a dovish rate cut if it happens to begin with? Or would it be a hawkish rate cut? Will we have a rate cut to begin with? So many outcomes, so many scenarios, folks. So again, I think that the market's assumption that we're going to have rate cuts in the bag in September is premature. And we're going to have to go through all of these events before we begin to have a picture of what the Fed is going to do in September. Anyhow, let's segue to the market information now. I'm going to begin with the morning brief that I issued today. And in a nutshell, you can stop this and read it for your own. I said I'm not expecting a move in the market, a big move before NVIDIA's report, because everybody will be waiting for that report. Nobody wants to place a bet one way or the other before that major report. In the meantime, we have maybe some technical patterns that we can play with. A bullish one in KHC, Kraft Heinz, a bearish one in IBM. Here's the chart that I gave you for IBM, weekly chart. It is flirting with a trend line. As you can see, it is below the 50 weeks moving average. It is forming a bear flag pattern, so why not take a bearish trade against it? With a stop loss if the chart trades and closes above the 50 weeks moving average. The next chart is KHC. We're looking at a daily chart, so we have a cup and handle pattern with a falling wedge. The assumption is KHC is probably going to head higher, so why not do a call options trade? If it works out, we're going to convert into shares. We have a stop loss below the 50 days moving average in blue. If we trade below, then okay, the thesis is no longer valid. We exit the trade altogether. Let's revisit the morning brief from yesterday. Again, we talked about the same dynamics that we're going to wait for NVIDIA's earnings. But in the meantime, NVIDIA or no NVIDIA, I think the assets that will outperform all the way to the next FOMC will be Chinese stocks, value stocks, and companies capable of passing costs down to the consumer. We're talking about the tariff cost. And I made a video for you. If you happen to be a member of the channel, please check it out. One of the best videos we've made. How to build a tariff-proof portfolio. I showed you some of the names and the companies that are able to pass the incurred cost from the tariff down to the end consumer. And better yet, we have companies that have no exposure to the tariffs, but they're going to use the tariffs as an excuse to do price gouging. And the stock market is going to reward these kind of stocks. Now, if you happen to be a member in the VIP or the Top Gun tiers, I also gave you my portfolio. This is my personal portfolio, and I sold 7 stocks recently, added 9 to replace them. So we also discussed these stocks and the themes that I see that are worthy of investing right now. So go ahead and check these videos, but we also added 2 speculative names here in today's session. One is the ticker DNN. This is a uranium play, Denison. And LCID, this is Lucid Motor. We're just going to rent them right now. If they work out, they're going to convert into a holding in the portfolio, as we've done with many of the names that I added recently. Some of them, by the way, went up by 50% plus since we bought them. So here we have a stop loss at 2 in both of these stocks. They're trading at a similar price. But if they work out and we have, let's say, a move up by 10%, 20%, we'll just keep them in the portfolio. Yesterday on my Discord, I said that DNN looks like it's coiling up for a pop higher. And here's the update. We got the pop higher today. And be honest with you, with the Trump administration right now and national security issues where we have to spend on magnets and uranium, because at the end of the day, believe it or not, we can talk about powering data centers by natural gas and green energy and solar. None of these will do the job. We need nuclear energy. So you're going to have some sort of a uranium play in your portfolio. Now, this is a Canadian miner. Most of the uranium that we import comes from Canada. These companies are not going to benefit from U.S. government investment, so you have to look for domestic companies. But again, as that happens, the commodity price of uranium goes higher, and it benefits all uranium producers. So it doesn't matter if you buy a U.S.-based company or a Canadian-based company, it wouldn't matter. Now, if you want to invest in an ETF that has multiple exposure in uranium, the ticker is URA. Now, if you want to invest in the commodity itself, you got the ETF SRUUF. This is the Sprout Physical Uranium Trust. And right now in the weekly chart, it is showing maybe an inverse head and shoulder indicating that we're going to head higher. So you got to have some exposure to uranium in your portfolio. Your pick, you do whatever you see fit, but have some exposure. Now, when it comes to Lucid Motor, they unveiled a new product. It's not really the best company. It doesn't make the best fundamentals at all. And specifically with weakness in the consumer, the case is so weak for buying Lucid at this point. But we see a falling wedge pattern. We're beginning to break out of that pattern. What if the stock produces 9, 10, 15% from the point we buy it? I'll take that gain. Renting it for a little bit, do 10, 15%, get out of the trade. Now let's add more color to this conversation, folks, by revisiting the market information today, beginning with the closing of the indices. And here we go. Your value stock rotation is the Dow Jones that was up by 0.3%. Your risk-on indicator is the risk-on meaning technology, momentum, growth. NASDAQ and the S&P, both of them were up by about 0.4%. So the market says, I'm not going to make a decision right now which rotation will work better, the value rotation or the growth rotation. But the Russell 2000, which is more sensitive to interest rate cuts, is leading the way today, up about 1%. And that could be the case all the way till we get the BCE, so why not add exposure to the IWM? We've done that on Friday via TNA calls. TNA is the 3 times levered index, bullish index for the IWM. Now, if the PCE comes out hot, then you're going to see the 2-year moving higher again, and the Russell 2000 is going to plummet. But between now and then, I think there's a trade to be made. Looking at these sectors on and all, you got industrials at number 1, financials, metals, healthcare, technology. So it's not a one theme here, not a risk-on or risk-off kind of theme. Although we have high dividend-paying stocks such as consumer defensives, real estate, and energy leading the pack to the downside. Looking at the breadth, again, the market maker wants it to be as neutral as we can before NVIDIA's earnings. So we see the NYSE 53% advancing, 44% declining. The NASDAQ 57% advancing, 39% declining. That's going to change after tomorrow based on how NVIDIA moves. So when we look at the heat map right now, can we extract anything? Yesterday I said we see weakness outside of the big caps, but we're probably going to see the inverse happening in today's session where we see strength outside of the big caps. And this is exactly what we got today. So we got the banks moving higher. We got healthcare moving higher, Eli Lilly, because a specific piece of news. We've seen industrials heading higher, and that's because of the comments by Secretary Lunatic in the morning, who said that, yeah, we nationalized Intel, but we can go more. How about we begin to buy stakes in the defense contractors, in GE, in Boeing, in Raytheon, and Lockheed? So we see all of these defense contractors heading higher. Gold miners remains a really attractive play. That's also heading higher today. You see some of the cyclicals made a comeback, such as the cruises. So again, the action today is irrelevant, to be honest with you. It's all going to depend on what happens after NVIDIA. Say NVIDIA goes down, you have the margin risk, and the margin risk will probably impact a lot of other sectors, such as banks, a lot of other technology plays, the retail investors kind of names. But it might initiate a rotation toward risk-off, aka value rotation. We're not going to know until we get NVIDIA's earnings and the reaction by the market. So let's move on. And we move on to commodities, and today we see a pullback in energy, crude oil, heating oil, the gasoline RBOB. We get a minor rebound in nat gas. Of course, the impact on crude today is happening because of the news from India. We still have the tension. There was the possibility that with the tariff that we see against India for buying Russian oil, they might diverge and buy WTI and buy Brent instead. So we've seen initially crude oil heading higher, but then it went down, and today it went down even more because the Indians would say, even with the tariffs, it still makes sense for us to buy Russian oil, not US or Brent oil. So with that, the Indians will continue to buy Russian oil, unless, of course, the White House decides to double down on tariffs against India from 50 to 100%. Then, okay, now we're talking. Now India has no other choice but to buy WTI and Brent. We see minor moves across the board here in metals and gold and platinum. No major moves in grains. We see in softs that OJ is leading the way, up about 4%. I think we have a squeeze happening underway in OJ. That could be a negative impact, by the way, on names like PepsiCo and Coca-Cola. But you got coffee. Coffee had an impressive run as of late, up over 30% in less than a month. It's pulling back today about 2%. Why do we see coffee surging higher? It's the tariffs against Brazil, top producers of coffee. So we see here that the supply in the exchange has been plummeting since the trade war began. And hence, you got demand for coffee still hot, but supply is nowhere to be found. It's a pretty good environment for prices to go higher. Just in case Jay Powell is paying attention right now, that's another case for inflation going higher. So why would you cut rates right now? Moving on to the options market, the big casino. What do we see here? The volume is down across the board. Like I said, nobody wants to make a move before NVIDIA's earnings. We see certain names worthy of trading, such as, Open Door. When you see the IV percentile heading to the 90s, closer to 100, you see it pull back all the time. You have NEO with an IV percentile of 96%. Now, NEO been hot lately. I think we're getting really close for a pullback in NEO because of that hot IV percentile closer to 100. But besides that, there's nothing else that stands out. Now, we do have an important options expiration date because of NVIDIA's earnings and the impact that comes from it. So when we look at the gamma exposure all the way to Friday, we're now a touch above the gamma flip, which means that the bulls have the advantage. You have your call wall at 650. The highest gamma. You have your put wall, highest gamma in the puts at 640. Do I think that we're going to break the walls in tomorrow's session? No. I think NVIDIA's earnings will lead to a break one way or the other. If, of course, the report comes out pretty good, NVIDIA reacts positively, we're probably going to break above 650 by the end of the week. If it's not, we're probably going to break below 640. If we do, what is the risk? You have to look at the open interest. And the open interest peaks, in the case of the calls, at 650. So we're not going to pass 650 without adding more exposure by the traders buying calls above 650 all the way to the expiration date of this Friday. I think the bigger move could happen if NVIDIA disappoints, because we could see the market being flushed down. Why? Because you got your put wall at 640, but once you pass 640, you break that wall, you have a pretty high put open interest at the 630 strike. And that could be revisited once we see NVIDIA coming out disappointing, so keep that in mind. Let's do the unusual activities. Beginning with this ticker right here, CIFR. This is a crypto mining company. And here we have the trader betting for higher prices to come. We're trading right now about $7 a piece. Now this trader bought the 8 call with the expiration date of December 19. So they think that CIFR will be trading above $8 a piece comes December 19th. But they also sold the 12 calls with the expiration date of October 17th to finance that 8 call leg that they bought for December. In other words, they think that we have a move higher, but they don't think it's going to happen by October. They don't think that we're going to pass above $12 a share by October. So they're using that leg to finance the main leg, which is the 8 calls with the expiration date December. All in all, spending about $1 million. Now, when I look at the chart of CIFR, maybe there is a case because we see an inverse head and shoulder, so it could pass all the way to 8, maybe beyond, under the right circumstances. We got another one for you here for the ticker UTHR, United Therapeutics. Here, the trader sold a bunch of puts, 290, 280, 270. The expiration date is October 17, 2025. They collected a premium of about $8 million. In other words, they think that this stock is heading higher all the way till October, and it's not going to visit 290, certainly not 280 or 270. When you look at the chart for UTHR, you can make the case both ways. You can say, okay, we got a double bottom right now, and higher we go, and the trader is going to be proven right, and they collected a very nice premium. There is risk, though, that we could see an inverse ABC pattern. Of course, we'll see more declines once we pass the double bottom at around, let's say, 270 or 267. By that time, of course, the trade is going to be bust. So this trader needs to see this chart right here, maintaining a trade above 300. You begin to dip below 300, we got a problem. And I got the last trade for you, happens to be a bearish one against the triple Qs, the NASDAQ. Right now we're trading at about 572. The trader bought the 560 puts with the expiration date of November 21st, 2025. Spending about $1.25 million. Let's do some charts, and we begin with the E-mini futures daily chart for the S&P 500. What can we see here? We have a bull flag pattern, pending NVIDIA, of course. But what I would say is trading above 6,500 before, but preferably after NVIDIA, is probably going to initiate more buying. Why? Because the money managers will have to chase. Whether they like it or not, valuation or no valuation, trading above 6,500 is going to initiate a wave of chasing. Now, I'm not going to short the index until we break and close below 6,390. If we do that, I'm interested in buying some put options, and I have multiple targets here, beginning with 6,240, and then we have many other targets to come, one step at a time. While I think it is a bull flag pattern, if you look at the trading view here, they think that this is a rising wedge pattern. And again, if NVIDIA disappoints, this wave, the wedge pattern, could play out and lead us all the way down to 6,000. That's what they think, and it is a legitimate target if NVIDIA fails to deliver. We look at the Russell 2000 futures. Again, I see a serious We got one bull flag right here, followed by another. You can argue an ABC pattern, now consolidating in a bull flag. The Russell 2000 is going to be sensitive to the 2-year yield and the prospects of interest rate cuts, not so much to NVIDIA, unless NVIDIA, of course, causes some margin calls. And we see portfolios dumping either way. If that is the case, you'll see the Russell 2000 heading down. But right now, the technical pattern that we have in the daily chart looks pretty good. We don't have a major movement in the dollar, and it's all over the place, to be honest with you. So what happens with gold? Still consolidating, no major move. I think that gold is going to stay still here until we get the FOMC. And then after the FOMC, it will make a major move. And I think that move will be to the upside. In the meantime, gold miners, the GDX is outperforming. It could still have plenty of momentum. Yeah, it is kind of overbought if you look at the other side, the daily chart right here. A little bit overbought, but it could go a little bit higher. It's close to a top, but it could close all the way to 62, 63 if you want to chase that. Maybe you want to sell some call credit spreads on it. I would say that the opportunity is in silver miners. So if you look at SIL, this is the ticker for silver miners. Nice rebound off the 50, showing a pretty nice pattern here of a bull flag that is breaking out. And the beauty of this one here is it's not overbought. If you look at the RSI here, still got plenty of room, at least more room than GDX. Looking at crude oil, USO, what do we have here? We got the target of the 50 days moving average. Now we're coming back. Maybe a retest of the 200 is coming soon, even if we go down to the 200. If there is a rebound above the 200 days moving average, it's still got the possibility of an inverse head and shoulder pattern, and higher we go. But if we break the 200 days moving average, then we got a problem, and this is as far as crude oil is going to go. No major update in Apple. Unless we lose 225, then we have a revisit to the 200 days moving average right here in or around 221. But absent of that, it could be somewhat of a larger ABC pattern, especially if NVIDIA delivers. Speaking of, right now, we still have the possibility of a topping head and shoulder pattern, pending, of course, the earnings report coming out tomorrow. I got my toilet right here at 174, meaning if we trade below 174 after earnings, we're probably going to see a flush all the way down to 165. Now, if the report is really horrific, then we can talk about larger targets. But right now, the market maker is pricing in a move of about 5 to 6% in NVIDIA. What about the souffle Tesla? Right now, it is breaking out in the bullish pattern. You have the triangular pattern break to the upside, and it came out probably confirming here an ABC breakout. What is the target? It would be the stop right here. That's going to be in or around, let's say, closer. The high was about 356-ish. So we're getting really close to our resistance zone here in Tesla. So if you chase this, you made profits, you probably want to lock some of these profits. If you want to trade on a resistance at about 355, you probably want to sell some covered calls or maybe sell some call credit spreads. And lastly, BTC, weakness here since we lost the 50 days moving average in blue. We got support though. We got support in or around 108,000. This is the consolidation right here. So it's in or around this zone. It's not the strongest support, to be honest with you. So if this support is broken, we're going to go down to 104,000. Let's move on to the conclusion of this video. What do we have in the economic calendar tomorrow? We got Richmond Fed zombie Barkin. I don't think he's aiming for a Fed chairmanship. Otherwise, he would have kissed ass. But he's not doing it. I mean, who wants the job right now? So maybe Tom Barkin is the smartest of the bunch right here. But the main event comes from the earnings calendar. We have NVIDIA. That's the big one, $4.5 trillion company. However it moves, it's going to drag the market down or up with it. We also have some interesting names such as CRWD, CrowdStrike, and Snowflake. We have a lot of talk right now that maybe some of these software companies will be disrupted by AI. I think that Snowflake will be an interesting case to look at. Anyhow, folks, again, a reminder, if you happen to be a member of this channel, we made a video last night talking about building the tariff-proof portfolio, and I also gave you my own portfolio. Check out these videos. But this is all I got for you for tonight. If you found this show informative, please help us out by pressing the like button, subscribing to the channel, leaving us a comment in the section below, participate in the conversation. What do you think? And better yet, join us as a Maverick member here on YouTube or Patreon. You're going to have links in the description and the comment section of this video. Becoming a member will give you access to all of the daily shows and the bonus videos that we do and many more. But with that, folks, this is all I got for you for tonight. Thank you for joining me. Appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Done. Done. Yes, I hate the doggy. Yes, I hate the doggy. Oh, 62 books.
Puisqu'on rêva de jours errants, pas la peine de changer trop. Ce souvenir, je te le prends. Des souvenirs comme ça, j'en ai tout le temps. Si par erreur la vie nous sépare, je le sortirai de mon tiroir. Je rêve les yeux ouverts, ça me fait du bien. Ça ne va pas plus loin. Je vais pas voir derrière, puisque j'aime bien vivre mon demain. Un dernier verre de sherry, du chéri mon amant. Quand je m'ennuie, tous les jeux se ressemblent à présent. Tu me manques terriblement. Ça ne va pas plus loin. Je vais pas voir derrière, puisque j'aime bien vivre mon demain. Un dernier verre de sherry, du sherry mon amant. Quand je m'ennuie, tous les jeux se ressemblent à présent. Tu me manques terriblement. Allons